Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Financial Leverage Explained: Benefits, Risks, and Real-World Insights. Increased returns on equity. One of the most attractive features of financial leverage is its ability to amplify returns on equity, ROE. By using debt to finance investments, businesses and individuals can grow their wealth faster than relying on cash alone. For example, imagine a business owner invests $50,000 of their own capital and earns a 10% return, netting $5,000. If they borrow an additional $150,000, with an interest rate of 5%, to expand operations, the total investment becomes $200,000. Assuming the same 10% return, the business earns $20,000 in profit. After deducting $7,500 in interest, the business still has $12,500 left. The original $50,000 investment has more than doubled its return. This is how leverage works to increase your ROE. It makes your money go further. Of course, this only works if the returns outweigh the costs of borrowing. But when managed wisely, it can be a powerful way to scale your gains without needing massive upfront cash. Tax benefits of debt. Interest payments on debt are often tax deductible, which is a significant advantage for businesses and investors. This means that businesses can lower their taxable income by deducting interest expenses, effectively reducing the amount of taxes owed. To put it simply, when you borrow money, you're not just paying interest, you're also saving on taxes. For instance, a company that takes out a $500,000 loan at a 6% interest rate will pay $30,000 annually in interest. If the company has a tax rate of 25%, this interest payment reduces taxable income by $30,000, resulting in $7,500 in tax savings. For businesses and real estate investors, this tax advantage makes debt an even more appealing option. It's like getting a discount on your borrowing costs, which can free up more cash for reinvestment or other expenses. Enhanced growth opportunities. Leverage allows businesses to access funds they wouldn't otherwise have, creating opportunities for rapid growth. Whether it's expanding into new markets, launching innovative products, or investing in state-of-the-art equipment, leverage enables companies to move faster and scale larger. Here's a simple example. A small business wants to open a second location but lacks the $500,000 needed for setup. By securing a loan, the business can expand immediately rather than waiting years to save up. If the new location generates strong revenue, the business can repay the loan while enjoying the benefits of increased market share and brand recognition. Why does this matter? Because time is a critical factor in business. Opportunities rarely wait. Leverage empowers businesses to act on growth opportunities now rather than later. While this involves risk, the potential rewards, higher revenue, stronger competitiveness, and long-term growth, can outweigh the downside when managed thoughtfully. Leverage also allows individuals to build wealth more quickly. For instance, borrowing to invest in real estate lets you own larger properties or multiple assets with less personal capital. As property values appreciate or rental income grows, the returns magnify beyond what you could achieve with cash alone. In short, financial leverage is a tool to unlock possibilities you couldn't reach otherwise. It's not about recklessness, it's about using resources strategically to achieve larger goals. Risks of financial leverage. Financial leverage has its perks, but it isn't without serious risks. Borrowing money to boost potential returns can backfire if not handled carefully. While it can amplify gains, it can just as easily magnify losses. Below, we dig into some of the most significant risks associated with financial leverage. Increased financial risk. Using leverage means a business or individual takes on additional debt, which raises overall financial risk. Why? Because borrowing money creates fixed obligations. Loan repayments, including interest, aren't optional, they're due regardless of whether the investment pans out. This can lead to trouble in situations where revenue or profits decline. Imagine a company sees sales plummet during a recession. Despite earning less, it still has to make its debt payments. The added pressure on earnings and cash flow can threaten a company's financial stability. For individuals, financial risk works similarly. Take someone investing in stocks using margin loans. If the stock price drops, their losses grow faster than they would if they had simply used their own money. The higher the leverage, the smaller the margin for error. Key takeaway: while leverage can increase potential returns, it also leaves less room for mistakes. If things go south, the financial consequences are magnified. Impact on cash flow. Leverage doesn't just affect profits and losses, it hits cash flow hard. Borrowed money comes with fixed repayment schedules, which can strain cash resources even when a business is profitable. For example, a retailer might take out a loan to expand its operations. While the new store generates profit, it may not produce enough cash in the short term to cover loan payments, especially if seasonal sales fluctuate. Even healthy companies can run into trouble when too much cash is tied up in servicing debt. Here's how leverage impacts cash flow. Loan repayments limit the amount of liquid cash available for other expenses, like payroll or inventory. In a downturn, when cash flow slows, fixed loan obligations don't adjust, they remain constant. Companies often have to dip into reserves or cut costs to stay afloat. It's a balancing act. If cash flow is tight, even a small hiccup, like a late payment from a major client, can create big problems. For individuals, a similar risk applies when leveraged investments reduce the cash available to cover everyday expenses. What's the risk? Lack of flexibility. Leverage can trap you into a rigid financial position, making it tough to respond to unexpected challenges. Potential for bankruptcy. One of the most dangerous risks of financial leverage is the potential for bankruptcy. When borrowed money doesn't generate enough return to cover its costs, debts pile up fast. The result? Insolvency. Consider a business that borrows heavily to scale quickly. If expected revenue doesn't materialize, it may struggle to meet interest obligations or repay the loan principal. Missed payments can lead to creditor lawsuits, asset seizures, or even forced liquidation. For individuals, borrowing to invest carries similar dangers. Let's say someone finances multiple rental properties with mortgages. If tenants stop paying or the real estate market crashes, they can face foreclosure. In worst-case scenarios, personal bankruptcy becomes the only way out. Here are common scenarios where leverage can lead to bankruptcy. Economic downturns. When markets shrink, leveraged businesses often suffer the most since they can't adjust debt obligations to match reduced revenues. High interest rates. Rising rates increase borrowing costs, cutting into profits and cash flow. Over-leveraging. Taking on too much debt relative to earnings limits the ability to weather financial shocks. What does this mean? The more leverage you use, the closer you are to the edge. Misjudging your ability to repay can trigger a financial collapse. Final thoughts on risks. Financial leverage offers opportunities but comes with considerable downsides. Increased risk, cash flow pressure, and the potential for bankruptcy are real dangers that need careful management. Remember, leverage is like fire. It can warm your house or burn it down, depending on how it's controlled. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.